Hello, you're most welcome to Business Stories on Business Television Africa. My name is Anna Maria Nyame. In the headlines, Ghana Revenue Authority (GRA) has organized a seminar for large taxpayers in the upstream oil and gas sector. Ghana's cocoa output is forecast to exceed targets set in 2013-2014. And the UK company Tullow Oil has become the world's first extractive firm to publish details of its revenue payments to governments broken down by each project the company operates worldwide. Ghana Revenue Authority (GRA) has organized a seminar for large taxpayers in upstream oil and gas sector to educate them on their obligations towards the state. This comes in the wake of some inconsistencies associated with clarification of capital gain taxes, withholding taxes, as well as some exemptions given to operators within the upstream sector. The head of petroleum units of the GRA, Dela Kubi, commented on Ghana's petroleum income tax law in the new Internal Revenue Amendment Bill, which impacts on tax liabilities of players within the upstream sector of the petroleum industry.
It's barely 4 years of oil production in Ghana, and many people still wonder whether the country is maximizing revenue generated from the petroleum sector for national development. There still is some misunderstanding with various tax elements, including whether the state should be collecting capital gains tax, whether contractors pay the exact withholding tax, and whether expatriate employees of contractors and other categories of foreign resident employees should pay taxes, among other concerns. It is against this background that the Ghana Revenue Authority, in an effort to clarify the situation, organized a seminar for representatives of large taxpayers and other stakeholders in the upstream sector to vent out their challenges and concerns. Participants included operators in the upstream, tax agencies, subcontractors, and vendors. In a presentation, the head of petroleum unit at the GRA, Dela Kubi, ran them through the petroleum operations and the fiscal regime of the industry in Ghana.
GNPC is entitled to 10% of any distribution of petroleum or revenue to interest holders in any petroleum operations. So, GNPC is an interest holder by virtue of this initial interest, and any oil that is produced, after taking the royalty, what is left when it is being distributed to the interest holders, GNPC will take 10% of that. Additional participating interest. This is an interest that is acquired in any petroleum operation by GNPC on behalf of the state after the discovery of oil and gas in commercial quantities. So apart from the initial interest, GNPC has the rights under the contractual terms in the agreement to acquire interest, additional interest in any petroleum operations. In respect of this additional participating interest, GNPC does not pay the exploration costs, but contributes towards development and production costs.
He also expatiated on withholding tax payable by contractors.
If a contractor grants loan to another person, that income is not income from petroleum operation. And for that matter, that income is taxable under the general tax laws of Ghana. And therefore, it cannot be argued that because interest income is not specifically mentioned in the petroleum agreement, the contractor is not liable to interest income in Ghana. This distinction must be very clear, because there is this misunderstanding that the contractor or the oil and gas company engaged in upstream petroleum is only liable to the taxes listed in Article 12 of the Petroleum Agreement. The first test that you have to make is whether that income is actually from petroleum operations. If it is not from petroleum operations, then it is outside the scope of that agreement, and therefore that income should be subject to the general tax laws of Ghana. And to go further, if you want to determine what should include in this general statement that activities related to petroleum operations, you have to look at the examples or the ones listed. All relates, most of them relate to income from petroleum produced. The royalty is on income, is on petroleum produced. The additional oil entitlement is on income, on oil produced. When you talk about petroleum income tax, it is the profit from the sale of oil. So specific, everything relates to oil produced.
On capital gains tax to be paid by contractors, which has been a source of controversy in recent times, Dela Klubi said the new Petroleum Amendment Bill has provisions to address the issues.
Capital gains tax, gains from the realization of an asset, is taxable under the capital gains tax provisions of the Internal Revenue Act 2005-92, as amended by the Internal Revenue Amendment Act 2013 at 871. And these are the exact words of that amendment. Despite any enactment to the contrary, the provisions of Chapter 2 of the Principal Enactment relating to capital gains tax applies to petroleum operations. Applies to petroleum operations. So, if there is any enactment that seeks to suggest that capital gains tax is not applicable to petroleum operations, upstream petroleum operation, it has not been clarified by this new amendment to the Internal Revenue Act.
Later, some GRA officials answered questions from a section of participants. BTA later spoke to some participants on their views about the seminar.
Weatherford provides oil field services to the field operators. Yeah, we have technology, we have manpower, we have rental equipment that we give to operators. We have products in well completion, well evaluation, drilling. So depending on which of the services is prevalent in any area, Ghana, near the waters.
It's a very good thing that the GRA has organized this forum for us taxpayers actually to come and interact with them. The point being that, as taxpayers, we file our responsibilities on a separate basis. So when we interact with them on this personal base, we are able to determine the things that we are supposed to do right, that we are already doing wrong, and how we can improve our compliance levels. Coming from where I do, we are an intermediary between taxpayers and then the LTO. We are consultant KPMG. So actually puts us in a very good position to bring forth to the GRA some of the concerns that we have with the GRA and then our tax payers, actually our clients. So it has been very successful. We hope that next time it is more interactive. They actually invite more taxpayers in a bigger forum. They discuss issues that are specific to the industry, because the point is the parties in the industries are actually very specific to the industries, and the issues are very different. So when we're able to bring them on board like this, under such an umbrella, we are able to discuss and understand some of the things that they do. So generally it's been good, and we are happy to be here.
In another development, the Ghana Revenue Authority has thrown more light on clarification of employment issues and what aspects of their benefits should be taxable under the law. This was when the official of the GRA, Dominic Nab, addressed participants at the seminar for large taxpayers in the upstream oil and gas held in Accra.
Employment, benefits and taxes have persistently emerged thorny issues in the placement process. Both employers and employees have become victims of inappropriate tax calculations, while many people have either knowingly or unknowingly avoided one form of tax or the other. Mr. Dominic Nab explains that everybody, including foreigners, must be taxed.
When we have a situation where certain persons, when they fall sick, are sent outside the country, others are made to stay in Ghana here for treatment, then obviously it is not equal. Then we have what we call a passage cost. With this passage cost, we are looking at recruitment and termination of employment. Certain three conditions must actually prevail. And one is the employment or the recruitment should have been done outside Ghana. And two, the person should be in Ghana for the purpose of serving the employer's interest. And the third one is the person must be a non-resident person for tax purposes.
Dominic Nab was also explicit on reliefs for married persons, old age, and other categories of staff.
Whether you are a foreigner or a national, the law says every person who is working in Ghana must actually contribute. So this 5.5% should actually be contributed by every person per the law. And I hear SNIT is actually in the process of registering every person, including foreigners, for this kind of dispensation. We have old age, that is also a relief. Once you are 60 or above and you are still in active employment, then obviously it will be given to you as a relief. Then we have a marriage relief. In fact, it is marriage and responsibility. And here we are saying that every person who is married can take advantage of that one. It's 200 Ghana cedis. 200 Ghana cedis, that's a big amount per annum. Here it is marriage stroke responsibility. If you are not married, but you can prove that you have 2 children, you are entitled to it. So if you have 1 child and you are not married, add another one. We have children's education. That is also 200, but limited to 3 children. If you have 4 children or more than 3 children, you will only be considered for 3 children who are actually schooling in Ghana. They must access their education in Ghana. Once it is not in Ghana, then obviously you will not actually benefit from that kind of.
He further commented on bonuses, overtime payments, and accommodation.
We also have situations where accommodation is provided to certain persons in certain organizations. The law says if an employer provides accommodation for persons who work in timber, mining, building, and construction, and also farming businesses, it should be exempt. But here we are talking about where the accommodation is provided on site. That is where the theater of action takes place. If it is not so, then certainly we would have to add it for taxation purposes. Then we also have situations where employees incur certain benefits on behalf of the employers, where it is supposed to be reimbursed. When we have a situation like that, then the law says it shouldn't be included in the determination of your employment income. Then we have severance pay, payment when you part ways with your employer. And this, the law says is so exempt. And here we are looking at redundancy situations. We are looking at mergers, reconstruction situations where the employer says that, well, you have done well, but in view of circumstances beyond our control, you may take leave of us. Such payment, the law says it is exempt.
Mr. Nab then explained tax obligations by persons resident in 2 geographical areas.
In the first place, the person must be resident in 2 contracting countries. The first one is your permanent home. Where is that person's permanent home? Let's take, for example, somebody who is a resident of UK and then also a resident of Ghana. So we are going to ask the first question, where is your permanent home? If your permanent home has to do with UK and Ghana, then obviously we can't break the tie here. We want a situation where the tie will be broken. Is that okay? So once you meet these 2 conditions, then we are saying that you are still a resident person of the 2 countries. Then we proceed to the next. And when we say permanent home, we are talking about a home that you can always have access to. So, for example, if you have you are coming from UK, as earlier on stated, you go back to your UK, home. You go there and then they write no entry. Then that is not your permanent home. But where you can always have access to, then that is your permanent home.
Ghana's cocoa output is forecast to exceed targets in 2013-2014. Reports say Cocoa Board has raised its forecast by 2.4% to 850,000 metric tons after good rains, especially in the Western and Ashanti regions, which had late crops. By January 16th, total bean purchases had reached 624,121 metric tons, 15% higher than the same point last season. Cocoa Board's winding down of its subsidized spraying and fertilizer programs appears to have limited impact in cocoa production, given that majority of the fertilizer was smuggled to neighboring countries. Nonetheless, the smuggling of Ghanaian bean to Côte d'Ivoire remains a problem, with an estimated 4,000 metric tons crossing the border since November. Ghanaian farmers who received 3,392 Ghana cedis per metric tons are attracted by higher prices in their eastern neighbor, where, owing to the depreciation of the cedi, the minimum price of 750 per kilogram is 18% higher in dollar terms. The failure of the Cocoa Board to release funds to local buying companies, LBCs, to purchase beans during the opening peak period is another factor encouraging smuggling. Cocoa Board has vowed to step in the patrolling of the borders to prevent smuggling, but this will be difficult while the cedi remains weak. In a bid to increase local grinding, Ghana is planning to introduce fiscal incentives to encourage processors to invest in additional capacity. Ghana's production of cocoa products rose to 225,000 metric tons in 2012-2013, marginally below the peak in 2010-2011. But grind capacity appears to have reached a plateau, and grinders who are struggling under high cost, especially for power, are unwilling to expend further incentives from the government. The UK company Tullow Oil has become the world's first extractive firm to publish details in its revenue payments to government, broken down by each project the company operates worldwide.
The disclosures, which were released in Tullow's annual report, show that taxes, royalties, license fees and other public revenues generated by the company's operations across 21 countries, 14 of which are in sub-Saharan Africa, for the years 2012 and 2013. Tullow's voluntary disclosures are being released in advance of a new EU law due to come into force in the UK in 2015 that will require EU oil, mining and logging companies to publish their payments to government on a project-by-project basis. These detailed disclosures will enable citizens in economically poor but rich resource regions to monitor public revenues worth hundreds of billions of dollars and hold governments to account for how the money is used. The disclosures deal a heavy blow to a lobbying campaign being waged by some of Tullow's industry competitors to keep revenue payments secret. The American Petroleum Institute, an oil lobby group whose leading members include ExxonMobil, Royal Dutch Shell, Chevron and BP, is trying to weaken the implementing rule for a U.S. law that requires U.S.-listed oil and mining companies to publish their payments on a project-by-project basis. The rule is currently under review by the U.S. Securities and Exchange Commission. Tullow's welcome disclosure blows a hole in the argument made by some oil companies that project-level reporting will impose a heavy burden on business.
The rising tension between Russia and Western states over the annexation of Crimea in Ukraine is bound to have economic impact on the European Union, which is a key destination for Kenyan exports. Financial experts contend that it is still too early to tell the extent of impact the geopolitical crisis will have on Africa's economies. The bulk of Kenyans' foreign exchange earnings is horticultural exports is resourced from the European Union.
Russian gas is very, very important to Northern Europe. that has to be taken into account. These situations happen from time to time. They're very unfortunate, but that's why it's very, very important for economies to be in trade agreements that allows them to have flexibility.
Whatever business we do with Russia, that may come under risk, depending on how far the sanctions go. It would be a catastrophe if it were China, because then a few things would come to a halt.
Africa is a key market for KPMG, given the growth potential it exhibits compared to other parts of the world. The company set aside $100 million, or about 8.6 billion shillings, towards various investments in Africa in its previous financial year.
We close our year in September. In our first quarter for 2013-14, we're actually growing at 25%.
We have seen tremendous growth, ranging from insignificant 10% year on year in the southern region of the continent. Here in East Africa, we grew by 18%. And if you go to West, we've grown by 21% year on year. Go to Angola, 58% growth.
The bulk of the funds so far has gone towards infrastructure, with the banking and telecom industries also getting sizable chunks. About a month ago, KPMG appointed John Weihermeyer as its new global chairman.
Now the closing headlines. Ghana Revenue Authority, GRA, has organized a seminar for large taxpayers in the upstream oil and gas sector. Ghana's cocoa output is forecast to exceed targets set in 2013-2014. And the UK company Tullow Oil has become the world's first extractive firm to publish details of its revenue payments to governments broken down by each project the company operates worldwide. This has been Business Stories on Business Television Africa. My name is Anna Maria Nyame. Thanks for watching.